Okay, thank you very much. Please permit me to sit down somewhere. So it won't be. I won't be like a teacher. Praise God. I believe mortgage is a very familiar. It's a very familiar subject in society. You know, everybody to an extent, at least. I mean, many people have a basic idea of what mortgage is, and I don't know the percentage, but a good number of a significant percentage of properties that I've, in fact, I should have actually done that statistics. A significant percentage of properties in the UK will have been financed by mortgage. You hardly see people buying properties by cash. There are people still buy properties by cash, but a good portion will be by mortgage, because mortgage. I mean, that is mortgaging a property. Property is a very capital intensive project, and for so many people, it will be the most significant and the most important financial decision that they've ever made. Which is why it's important to understand property, mortgage, and things like that. Some years ago, there used to be a debate about that is mortgage versus renting. Which one is better? I mean, which one is cost effective long term? It was going on for some years. Because when you are renting, you have some advantage. For example, if you are renting a property, if you are renting a house, if anything happens in your house, just call the landlord to fix it. That's not your problem. So if you are renting, you are not bearing that cost. Okay? If you are renting a house as well, you are not. It's not your headache to think about insuring the property. Your own headache will be insuring the content, and you are not then any obligation to do that if you don't feel like that's your own cup of tea. Unlike if you have a property, it's not so much. You don't have an option. So all those things. If your boiler breaks down, you just call the landlord. But if it's your property, your boiler breaks down. Yeah. So that debate was going on, saying, can you just put your money and save it, whatever, Now, but owning a property, you give the general before I go to, owning a property has so many benefits and advantages, financial and non-financial. Let's first of all look at non-financial. Owning a mortgage provides stability, particularly for families. Okay, it makes for example, because it provides a home, as it were. Okay, even if either maybe the mother of the house or the father of the house, like in my case, some years back I used to contract, and I was going from places to places. But you have a home, and particularly as children are growing up, children are they benefit more from the stability of home than others. If you are renting, you are at the mercy of your landlord. Yeah, even when it's good, or 2 or 3 years. But if he decides he wants to use the house or whatever, you have to leave. So that doesn't provide stability for children who need to grow up in a neighborhood, they are familiar with. It can be disruptive, school, looking for schools and things like that. So owning the property provides that stability, for that. And it also provides what you may call gives some emotional value. The idea that you have a property is yours. But those are just non-financial. But the financial aspect is that statistics, that is for so many years, I'm talking about many decades or even generations, have shown that properties are one of the best investment decisions. There are other things you can invest in, stocks, in shares, whatever. For example, properties appreciate, that's not that one. Properties double in value almost every 10 years. and not this is global. It doesn't matter. It's not just there. Anywhere all over the world. Properties double. So which means if you buy a property 200,000 pounds now, in close to 10 years or 10, 11 years, you should expect that the value of that property will be close to 400,000 pounds. Now, the positive aspect is that as your property is increasing in value, if you have a mortgage where you are paying that, so it means how much you are owing is reducing. So how much, so that equity, what they call equity is the value, what is left in that mortgage, as increasing. So it is your advantage. So whenever you want to sell, which is why people invest in properties. So I just wanted to give that background. So home property ownership is very, very significant, it's very, very important. However, because only very, very few people in society can afford, as a matter of fact, even those who actually have cash, what they do really is that why use your money? That's actually what they do. Why use your money to buy property if you can get a loan? They'll use their money for something, maybe another. For example, if I have an investment that can generate 7% per annum. Okay, I have 500,000 pounds, and there's a property where the interest is 5%. So which is the best one for me to put my money on? So I put my money on 7% interest. I borrow money, and that's just basic meditation. I borrow money and pay 5%. So because my money, the interest my money is working out is enough to generate it. So even people who have a lot of people who have, all the rich people. So that's what you're talking about, using your money to work harder for you. So they use their money on other things. You understand? Provided the returns on that investment is much more. So they just borrow money. So a lot of people borrow money, for doing that. So now, God will take us to that level in Jesus' name. Amen. So mortgage is a secure loan. So we need to know that to get a mortgage, the word you hear things like don't mortgage your future. That's loosely, don't mortgage your future. So mortgage is it's actually a loan borrowed from the bank or from a lender, because they are not only all banks, from lenders to buy a property. Okay? Now, why is it significant as a secure loan? It means that property is being secured against the loan. So it means, technically speaking, that property doesn't belong to the person. So if you have a property and there's mortgage, technically speaking, the property does not belong to you. It belongs to the lender. All through the period of the terms of the mortgage. Which is why if there's a default on the property, they can take the property back. They can possess the property, which is not always very good, because if they possess the property, if for example someone takes a mortgage of 400,000 pounds, and for a reason the bank or the lender possesses the property. Now you understand, there's still amount of money the person is owing. By taking the property does not mean you are free of that obligation. What they do mostly really is that they auction the property, because they are interested in getting their money back very quickly. So the property could be worth 400,000 pounds. They could auction it for 700,000 pounds. And so if you borrow 500,000 pounds, 400,000 pounds, and the auction for 300,000, whatever is left from what is sell it for, and what you are owing them, you are liable to that. They will come after you for that. They will come after you for that because you are owing them. So it's not because they've taken the property, say, I'm free. No. So the person is not free until he's free. They say it's not over until it's over. The person is not free until it's over. So it's therefore not a great idea for one's properties to be possessed, because usually just fling it and they sell it much less for how much it's worth. Okay, so it's a secure loan. So, and because it's a loan, which means that decision is not taken lightly. You don't just jump into it. You look at so many things, your financial circumstances, your family circumstances. Am I able to pay? I mean, it also helps you to look at, okay, what sort of interest should I, is it variable rate? We'll talk about it later, or fixed rate, okay? That's the first thing. Secondly, now for most mortgages, I think some years ago as well, there used to be mortgages where almost 100% of the bank, the lender will give you. But in most mortgages, you will need to pay a deposit. And the typical deposit is 10%. You can find there are lenders who may offer 5%. Okay? And when the mortgage market is very, very active, particularly hyperactive in hyper economic booms. I think we had something like that before 2008, when before the financial crash. There are lenders, they call them hyper lenders, even lending people 100%. So we will give 100%, give additional money to make up the house. That's one of the things that resulted in the financial crash. Then, okay. So, but typically you will be required to pay a deposit, so it could be 10%. So, which means if you're looking at the property of £400,000, you'll be required to maybe pay 10% deposit. But it's not. It's a minimum. The deposit expected is a minimum. If you have 25%, if you have 50%, so they offer you the balance of that. Okay, so they give the balance as a loan. Now, so this is what they call, I don't know, some of what we have come across what they call loan to value factor. That's what they use. That's really so. What it means is that if you are buying a property of £200,000 and you have 10%, you are lending 90%. So the loan to value is 90%. That is the loan, how much you are borrowing versus that is as a percentage of the value of the property. So that's what they call a loan to value. And the LTV can influence the rate you get. The interest rate. Usually, the more you can put that as deposit, the better chance you have of getting a better rate. And usually, let's say there are two people. Same property, £400,000. So one say I have 25% deposit, another one say 10%. It's more likely the person that has a higher deposit, the rate he will get will be lower than and I think it's the principle of risk returns. When the risk is higher, then the return they want to get, that's the bank, the return because the interest is a return for them. The return that they want to get is higher, so the interest is higher. So when their risk is lower, so which means if you have, so the more the deposit you can afford to put there, the better chance you have to get your chance of getting lower rates increases. So deposit therefore is very very key. Now, where can we get mortgage? Not like I said, not only banks, but almost every bank offers mortgage. So typically you can walk into a bank and book an appointment. It's not the best, it's not the ideal. But yeah, that's one way. There are also comparison sites where you can. When I bought my property, I used comparison sites. That is always the most cost effective. There's a site here which I've placed on a site. Let me just mortgage savings. You can mortgagesavingsexpert.com. I'll put it on the main fellowship. That's one site where you can just like other comparison sites. That's where it does you put all your parameters, whatever, and what it does really is that it scans through the market. It scans through the entire market, whatever, and offers you to see all the options, whatever, and you can actually, you can click and approach the lender through that. So that's one option. The third option is to go through brokers, what they call high street brokers. High street brokers, there are companies who are brokers who offer mortgage advice to people and things like that. Now, high street brokers could actually have an advantage because sometimes they have access to exclusive offers that are not available online. They also have access to lenders who are willing to lend money to people of peculiar circumstances. For example, if someone is a self-employed person, now because before they can offer you mortgage, they have to do income assessment. Now, self-employed people, it can be a bit, assessing their income might not be very straightforward. So the traditional lenders might be a bit, they might be hesitant to do that, but if they do that, the interest rate might be high. But the brokers, they have access to lenders who are willing, who see that one, who don't see the kind of risk that others see. So that's an example. Or if someone has a slight issue with his credit score, we're going to talk about that later, how it affects that. So high street brokers, might provide an opportunity for someone for that purpose. So high street brokers, using them is an option. Now, let's go a little bit into now I'm looking at it from the premise of first time buying, because if you have bought a property before, certainly you won't need this information. so first time buying. So let's just look at cost. So cost of buying a property. Now, the cost of buying a property is not only the deposit. I've mentioned the deposit we need to pay. There are other costs. For example, before labor came in, how many people are labor before here? I know what it is. How many people are labor party?
Silence.
Are you?
No.
Yeah, brother.
I used to be.
So where are you now? What are you?
Floating.
Now, I think pre-labor, like this from April, if you buy the property up to first-time buyers up to £500,000, you will not pay stamp duty. Stamp duty is free. Okay. But now from April, from this April, is it 2 days from now? You will not pay. You will pay 0%. You won't pay anything for the first £100,000. You won't pay anything. Okay. But for the next £200,000, you pay 5%, and anything above you pay 10%. That's from
Stamp duty.
Yeah. Labor is a tax. So that's a cost. But if the property someone is buying is not beyond 100,000, then that will not be. But those are things that one need to factor in if you want to buy a property. Of course, there are other costs. May not be as significant as the deposit, but there are other costs to factor in. There is what they call product fees from a charge, 500, 900, whatever. But usually, what this calls the corporate product fees, you can add it to the mortgage. If you don't have it, you can say, okay, I'm buying whatever. They can just add it to the mortgage. So you don't have to pay it upfront. There are valuation fees before they give you. If you find a property, banks have to value it, and usually when they value it, you pay the cost of the valuation. There are other things.
Hey, you're the first one in here. Can you let me know?
That's okay. If you use brokers, some brokers may charge a fee. They are not huge, but those are all costs. If you buy a property now, I'll move fast, I'll come forward, but so that everything might not just go sequentially. Now, other costs, if you buy, the way you buy a property here, if you once you find a property you want to buy, now there's what is called conveyancing. It's legal terms. So you get a lawyer, so to say, but it's not only lawyers who do conveyancing. There are conveyancing companies, the internet. So, but it's a legal service. So you find a company that provides conveyancing. So now, you will have a conveyancing company. The lender will also have a conveyancing company. So really, the discussions about buying and purchase take place between your conveyancing company and their conveyancing company. For example, when you want to pay your deposit, you don't pay your deposit to the bank. You pay your deposit to the conveyancing company. So they are the one that now they'll be talking to the legal of the whatever. So all that will be taking place. So, and when they want to transfer money, whatever, they may ask you to pay what they call telegraphic fees, whatever for that. So I'm just talking about cost. Okay, so that's about the basic. Now, because, like I've said, mortgage is the most significant, important financial decision for most people ever. Okay, and I've talked about because the property doesn't technically belong to you, it belongs to them, and it could be repossessed. Now, it's so important, therefore, that, of course, mortgages are paid. That is, any mortgage due on a property is paid monthly. It is paid monthly. Now, and there are two options. You can decide. You can choose what they call repayment option or interest only option. But typically, interest only option is for if you are doing buy to let. Most people do repayment. Repayment just means every month you are paying a portion of the capital down and a portion of the interest. The way mortgages are structured, they actually load the interest. They load the interest element in the fewer years. So you're actually paying a much higher portion of the interest. If, for example, on a monthly basis you are paying £500 monthly, it might be the portion of the capital you are paying is just £50, and £50 is the interest element. So that's how the structure is. If you are getting towards the end, like just discovered that the interest becomes lower. Okay, so because it's so crucial, you can never afford to miss payments. You can never afford to miss the payment, on a credit card. Remember, it's a loan. The property is secured against it. So there can be a huge cost to missing payments. So which means the risk of the house being possessed is higher if payment is missed. I use the word risk. It does not mean once whatever, you understand, but the risk is higher. And of course, if you miss monthly payments, you already know. In case you don't know, that will impact your credit. That will impact your credit score right away, because they report. All credit companies report your credit performance, your credit history to the credit bureaus on a monthly basis. So they do that. So you can't afford to miss payment. You also cannot afford to delay payment. If, for example, you are supposed to pay 25th of every month, you can't afford to send your payment on the 26th. All those things increase the risk of possession. So to do that, just like most credit transactions, if you once you take a mortgage, the first important thing you must do is to set up a direct debit. It's a mechanism to ensure that you never have to bother yourself remembering, oh, I'm supposed to pay my mortgage on the 28th or whatever. So you set up a direct debit to your account. That's where your money, where the bulk of money is, maybe where your salary is. Okay. So that's very, very, very important. Now, let me go back slightly. Let me see, maybe something supposed to have. Okay. Now, I thought I should have mentioned that. Assessment. Oh, I did maybe. Now, when you want to buy a property, now they assess you. That's an assessment into how properties are. Assessment is based on one, the loan to LTV that I mentioned about. Now you can also be assessed. You will also be assessed based on your income. Your income in this case can be, if you want to take the mortgage as an individual or a family, they can use your household. You will use your household income. Okay, so they use your income to do two things. Number one, normally, so it's not just LTV. It's not just that you want to buy a property, 500,000, you have deposit, and it means they will now loan you 90%. It is still subject to how much of income. They can say, okay, we can't give you a loan beyond 4 times of what you earn, 4 times of your income. So it's subject to that. So if, for example, if what they can give you is 4 times of your income, if it is lower, if it is, again, you want to buy 200,000 pounds property, I have only 10% deposit. So which means what they could give me is 1,000, but when they roll my 4 times income, it comes to 150,000. So that means they cannot lend me more than 150,000. So they use that one. They use the income to determine that. They also use the income as part of affordability. So to get a mortgage, in getting a mortgage, of course, you have to have a very good credit history. Credit is very, very important. This conversation is not about credit, but you can't run away from talking about credit when you're talking about mortgage. Again, like I said, it's the biggest financial decision that most people will make. So your credit history needs to be very good. So particularly for many people who come to our country, here we came from an environment, a society where, in fact, if you say you want to take credit, you will even think it's a cost. So credit is strange to so many people where we come from. So one of the things you do when you come here is to deliberately build a credit history, credit profile. You do that by making sure you are registered on the electoral roll, because the first thing they will do if you want to borrow money is to check your identity. And what the first place of call is electoral roll. Are you registered on the electoral roll? Okay, and you start building credit history, like apply for an overdraft. When you have an overdraft, even if you don't need it, occasionally you can put your money into have a savings account. You have a current account that has overdraft, and you have a savings account. You can put your money into savings account and occasionally deliberately overdraw the overdraft. It doesn't matter by how long. It can be by 1 pound, by 2 pounds, and you leave that for like maybe 2 weeks, because every time your account is overdrawn and you have capability to pay back, it is reported as a positive thing that you have a credit profile. So that helps over a period of time to build your. In fact, that's even another smart thing really you could do. I think I told my daughter to do that some times ago. Now, if you have overdraft, or maybe you have a credit card, let's say credit card. If you have a credit card, usually when you have, now I have my day-to-day, that's one way of building a transaction. My day-to-day, what do you call it now, expenses, I don't use my debit card, I use my credit card. I don't use my debit card at all. Now, but I have a direct debit on my credit card to pay off everything at the end of the month. 2 things it does for me: it keeps my credit history active. So it's not about if you have money; it keeps my credit active. Now, because all credit cards, the money you borrow from them, you always have a grace period before interest kicks in. For many of them, 45 days. So now, if I use my credit card, they want to be 30 and I pay at the end of whatever, it's free money, no interest to be charged. Because at the end of the month, having direct debit, that shows that everything I have, for me, that was a way of making sure I keep my credit alive, even though I don't need it, and at the same time, no interest is incurred. So my credits, so I always have credit. So that's one way. One of people of you can build your credit life. So it's not a matter of but I don't need it. I don't need even though you don't need it, it can be very, very helpful, particularly for your buy mortgage. And if you are considering buying a property, which is, like I said, is major, try to avoid any major credit decision within 6 months. Like, try to avoid applying for another credit card within that period. So if you need a credit card, whatever, maybe make sure all those things are in place like at least 6 months before that. Okay, because each time you apply for a credit card or any credit decision, of course, it signals to the system that you are taking a new credit profile, and when you do like whatever, so it can affect how you are perceived, how you are seen. So those are
as well.
sorry.
And house movement, moving house.
Okay, yes. I talk about stability here. So the same way if you are rent, of course, many people will be renting before whatever. Make sure you have done all that. Don't move house in 3 months and now apply for a mortgage. Yeah, because all those things, of course, movement of houses affect your credit score. So, and of course, they look at affordability as well. If you can afford it, they will look at now. You can't hide so much, because for as long as most of our transactions are from the bank, they can actually connect your bank, and they can look at the profile of your expenses to know if actually you can afford it. Okay. Let me run very quickly because I want to give opportunity to question. Now, how to find a property? Of course, use online agents. In this country, you just use online agents. Okay? But now, this is now my personal, don't just buy any property in any area, because don't buy property, it's okay, which area? Don't just say, I like that property. It's fine. You need to do background check of the neighborhood. Remember, I started by saying property provides stability for home, particularly for children. So you can find a beautiful property in a place that is not suitable for you or your family. So the beauty of the property is not, wow, I remember looking for property. It went someplace back. I can never forget that. And I thank God I did that. So, God bless you. Okay. So, we were looking for property. So I found a property. Very nice, beautiful, big, large. I was asking. So I just went out. I went out of the house and I just walked. And I saw some boys. How many know what they call joyride? I don't even come across that time before. What they call joyride. Okay. Some of these. Okay, what about the term ASPO? Have you come?
Antisocial behavior.
So there are children. Usually they are teenagers. You find them in neighborhood who are nuisance to the environment, and so what they call joyriders. These children, young people, maybe 15, 16, whatever. They could steal cars, not because of anything, and they call it joyride. They just be driving it recklessly, whatever. Okay.
Street racing. Do street racing.
Street racing, yeah. You used to call joyride. So as I went, I just saw a car. So I just walked, you understand, and that's part of intelligence in you do. So I just asked, so I was to say that in joyride. That automatically tells me about that neighborhood. That cannot be a neighborhood where my children will grow up. That tells you right away about that neighborhood. So you do basic background check of that of that environment. For example, what's the profile of people who live there? Okay. Now, if for example most people who live there are not employed, there could be potential issues. What is the crime profile of that area? So again, like I said, so you don't just buy a property because it's beautiful, it's large, whatever.
Registration number.
Yeah, you're right. So
I wanted to learn.
What sort of cars?
Pastor told me.
Yeah, what sort of cars? You need all those things, whatever. You need to car like yes. Those are the things for if most cars you are seeing, they are old cars or whatever. It's not that, but these are the things you think you make sure you do your research. Of course, for most of us, for all of us children, you research the schools in that neighborhood. You know, there are websites where you can get us information. What kind of schools are they? There are schools where there are schools where a high percentage of children are on what do you call it now? What do they call this again? Children who take benefits. Yeah. Where a high number of students, their parents are on benefits, and it is proven. Schools where a high number of children whose parents are on benefits, those schools' quality is always done. That's where you find children whose schools are highly disruptive, whatever. Of course, so those are the things you check. Those are all the things you look before you say, okay. So you may find a house that doesn't meet what you look for, but maybe the environment is very good. The neighborhood is very good. And because all these things also affect the value of the property long term. So you can have a property that doesn't look so good, but in a good environment. And very good, the value of that property will appreciate with time much faster than the beautiful one in an environment that is not I use word that is not good. So those basic we need to undertake those basic research before we decide. Oh yes, before. So you check postcode. In this country, that's what I call postcode lottery. Postcode lottery. The GP, the medical services in that place. What's the quality of service being offered by? I wanted to change a GP because but when I was checking, I discovered that wow, other places I was thinking about is terrible. I just don't worry. I'll stay. So those are the things that even though these are not factor about mortgage, but those are the things you must consider because I want that property. Of course, once you have the property, like I said, then you approach banks. They run through applications. They have what they call give you approval in principle, and once you do that, then you get your conveyance gets involved and the rest. Will you be accepted for a mortgage? Anyone as in mortgage lenders, they have different standards and requirements. We've mentioned some of that. Of course, you look at your job status and things like that. What kind of job do you do? There's also this is about credit now. There is also, how many of us know money savings experts? If you don't, I advise and suggest you just subscribe to them. It's free. You get tips about so many things, financial investment. Now, money savings expert, for example, will give you advice. When you're looking for running credit application, they will ask you your job status. Now, sometimes your actual job status might offer a high, the way it is designation, might offer a higher risk that can increase your risk. So it might be you took it to something else. It's not lying, but what you took it to suits more will suit you. You understand? So if you go to a money savings expert, all those things will help. When you want to make a credit application. Other things that can determine either interest, credit, whatever. The value of the property I've mentioned, how much deposit you want to give, your age. Age is very, very key. So many, thank God, so many of us, age is an advantage. When I came to this country, age was one of my advantage. Because usually they give you property, then you look at the retirement age. So for example, if you are 50, and then it used to be 65, if you are 50, you want to take a mortgage. So it may really, the longest time they could give was 15 years. Then, okay? So, but in that time I was talking about the financial crash, they used to give you up to 70 years and the rest. So age is also a factor. So if you are, which is also if you are young, when you get a mortgage at a younger age, then the longer the payment can be, which can be good. So the age, the length of the mortgage time, your credit card, our income, and of course, if you are applying solely or jointly. If you are applying solely, it means your income can be assessed jointly, so which means you can get a higher mortgage and the rest. So I've mentioned, tips for a successful application. Stay clear of major credit decisions like 6 months before. Don't move house. Make sure you within that period and the rest. Now, let me share what I didn't experience, but what I learned from. I said that properties appreciate in value. Properties double almost every 10 years. Almost every 10 years. So, because it doubles every 10 years, a lot of people want to also go into buy to let, to be landlord, whatever. Most issues for them is deposit. How to get a deposit. Now, since properties appreciate, double almost every 10 years, what you can key yourself into in your mind is, like 5 years after a mortgage or whatever, your property started appreciating in value. You can actually take money out of your property and use it as a deposit to buy property for buy to let. That's something I didn't know until very, very, very late. In fact, it was too late. So, if you have 25 years, let's say you're able to get 25 years mortgage, you buy a property at 200,000, and let's say, I don't know what deposit you put in. Let's say 5 years after, the property is worth £250,000, like I've said. Because it's worth, so it has increased in £50,000. So, equity, but more than that, because you have also paid, I don't know, just rough number or whatever. Let's say you paid £7,000 of it. So it's actually increased by 57. You have additional £57,000 on that property. So you could actually technically borrow £50,000 out of that.
Wow.
That is remortgage. You are remortgaging it. By taking money out of it, you can now use this, you can now take another mortgage, depending on the deposit. So many people build buy-to-let property portfolio, on that. So I believe that will be useful too. So don't just think, as if I'm for ownership, think of it as well. So which means you are monitoring the value of your property, like on a yearly basis, whatever, looking at, okay, at what point can I take money out of it, whatever, to build a buy-to-let portfolio. Okay, what else? I like it to be more like question and answer, but I've not talked too much. So questions,
When you mention, sorry, I have a question. When you mention taking money out of it,
Yeah.
does it mean you are no longer the owner of the one you took money out of? You're remortgaging it. What does it mean?
No, the property is still yours. Okay, if I borrow, like I said, I'm buying the property £200,000. my deposit is £20,000. So I'm borrowing £180,000.
Yeah.
So that is my mortgage. So that's what I'm paying down back every year. Okay? So there are two aspects of mortgage, really. I mean, two parts of the mortgage. So if in 5 years' time that property has increased in value to £250,000, okay? So two things I can, even people do it for other purposes. People can say, okay, I want to borrow additional money on my property. Remember, when you mortgage, you are securing your loan, you are securing the property against that loan. So some people take money out of property and they use it to actually to extend the house, whatever people do that. So what you are doing is that you are borrowing additional money, but you are using your house as a security for its collateral.
Okay.
So it is still yours.
Yeah.
You understand? But it just means, okay, so when you are doing again, you borrow £80,000, you are paying that. So of course, when you borrow more money for that period, your interest will also increase anyway. These are the things you factor into it. But it's an investment decision. We are looking at all these versus, okay, if I buy a property, buy to let, rent, so it's all financial decision you are looking at, okay, how much I'm paying interest versus how much rent I'll be getting from this. So it is still your property, but you are just borrowing more money from the bank. Your property is used as a security for it anyway. And so that money you could use it to pay for deposits or to be part deposit for another property that can be part of the property. Yeah.
So sorry, sir. So if I understand about the debt portfolio, will be like you have 200,000, you pay 7,000, so then you take 50,000. So your debt profile will increase like 250,000.
Of course, yes. That's what I'm saying. Your interest rate will be recalculated anyway. How much you are paying will be calculated. So for those items you factor into anyway, I mean, it's like it's an investment decision. Say, can I afford it? Or if I can afford it, okay. Or it might not just be affordability. If I'm buying a property, let's say my monthly repayment, let's assume it to go up by say £200, and I'm buying a basket. I'm generating. Of course, when you're doing basket, you're looking at how much you're getting as rent versus mortgage you are paying on it, and what you have left can still pay for this increase, whatever. And don't forget that it's also an investment decision. This property you are buying also has potential of doubling in value every 10 years as well.
And then with insurance.
Yeah, this is
insurance,
it's not
for the tenants.
for the tenant. Yes,
Because a friend ran into trouble with that. The tenant didn't pay. It was COVID time, so he has remortgaged. So it was a very serious offense. What took him out was the insurance for this. So the insurance company were paying him definitely it mustn't miss the monthly payment from the second property, because if he misses that, it's going to be enormous because you have already incurred a large debt profile. So those people couldn't afford payment, and they said they are not going. So it was a very long. But the lesson I learned there is insure the tenant. So the insurance was now paying the mortgage.
Now I mentioned it does not mean it is automatic. There's no financial decision or investment decision that is automatic. But I'm just saying an opportunity. It's a possibility. So you can't just say, Pastor Gungwe said so. You have to. Now because he mentioned it, I'm sure the lenders will even allow that. When you take a mortgage property, you must insure it. Of course, they will insist you have insurance on it. They will insist. But what I discovered is that even though they insist you have insurance at the beginning, they don't necessarily follow up. Because I think apart from the first year, from the first time that my mortgage company, they never came back to ask me if I had insurance. But please make sure the property is insured. You should make sure. If you don't insure the contents, you're fine. But insure the building itself, of course. Why won't you insure the contents? They are really how much you pay for them is not really very, very much. Insurance property might be £150 per annum, whatever. So the property has to be insured, and when at the point you are buying it, they will ensure you have insurance. Some lenders actually want to also make sure they want to ask if you have a life insurance, if you have a life insurance, whatever, anywhere, you understand. Some ask for things like what sort of policy you have in your employment. As in, if for example someone is sick, how much can they, in supplement they can say, okay, if you are sick for 3 months, you pay salary. So there, all this come into a factor into it for them. If you want to, give you the insurance. Why they are particular about that is that, okay, if the person just dies, will they be able to collect their money back? So these are all the
Question, sir.
Yes.
So I've got 2 questions. Well, not a financial advice anyway, but in terms of now in this climb now, where based on interest rate and all of that, maybe I'll use myself as an example. I think when I started then, my rate was, I think, 1 point something, and if I had known then, I think there was a 10-year option. I would have gone for the 10-year option back then, but it was now that I was looking at, whoa, but then maybe I didn't have too much information, or maybe at the time, there are chances that I would have been looking at maybe it's going to come down. But now, for people that want to get on it now, based on the rates now, what do you think should they go for a long term or do a short term? And the second question, sir, so you can answer at the same time. And in this current climate as well, now I think you tried to give us an example in terms of if you have an investment that gives you 7% and then your interest is 5%, does it make sense to overpay, or you just find an investment that gives you higher than the current rate?
Let's look at overpayment first. If you just look at mortgage on its own, overpaying is very advantageous, because when you remember I said that the way they structure their interest, they load it to the first, the fear in the first year. So you are paying, and whereas when you are overpaying, because you are reducing the capital, so which means you are significantly reducing the interest. So on that basis, it's advantageous. Okay, now, but overpayment always has to be viewed, and that's from a typical you have to also view it as in this money. For example, you are someone who's business savvy, all those things. You can view how much you want to overpay versus if I invest this money, if I change it, how much am I going to get? So at the end of the day, it's a business decision here, so to say. So you don't take your understand, but for not everybody is business savvy. So if I just maybe you understand, it could short term, and of course it could be advantageous because it's also reducing. Of course, it reduces your capital. That's what it reduces your capital. It reduces your interest, which can also play to your advantage if in 5 years you want to take money out of the property, you want to use it for buy to let, whatever. Now the first one, you can never prescribe or recommend and say this is the best, or take variable fix. It always has to be based on the person's circumstance and what you may call your risk profile. Okay, for example, when we took a mortgage, at that period, for me, the most important thing to me there was what we may call predictability. I wanted, the challenge of variable rates is predictability. You can't predict when it will increase. So for me, I was just taking, also maybe I can use that one. It was a first time experience. I didn't know issue, so I just took 5 years, whatever. So one, because that's a fixed time, 5 years. Now, it could be 2 years after I may discover that it is I'm paying But the fact that I could predict how much I needed to pay every month, it gave me peace of mind. So I have peace of mind. So if you're someone who wanted predictability, you understand? So it gives me peace of mind. So I know for 5 years, that's how much I'm going to pay. You understand? Okay? And of course, also based on my income, of course, I knew that my income would support it. So that's one factor. So you can't legislate and say, take this. For me personally, I think longer than 10 years, I think it may be a bit too long, particularly because you can never even predict economic cycle of out in 10 years. But I think 5 years, so that's one. So I think I did 5 years, 10 times. The only time I did, okay, it was also fixed time, that I reduced it to 2 years. Which is other thing. At that time, we had how I've significantly paid back from capital, and I look at it that even if interest rate significantly over this, I could still afford it. And so the interest rate was like, say, now I'll take the risk. I'll go for fixed time 2 months. It's like, you understand? Say I can, if you increase it by so, since the capital, whatever has gone, I could still afford it anyway. So let me take advantage of the lower, and it paid off because interest rate was very low for fixed for 2 years at that time. So these are all the things you factor into to determine if whatever, but you can't really say, oh, go for 2 years. It has to be based on the person's circumstance, your risk profile, what you're comfortable with, you want peace of mind.
Should we discuss self-certification? Do they still do self-certification?
Self-certification, particularly for self-employed people.
Well, it doesn't have to be self-employed. If you think I'm not sure whether they still do it, but if your income cannot support the kind of house you want to buy or the amount of money you want to borrow, and because you have supplement income, like for instance, some of us who may have one job and you are doing overtime, mortgage advisor will not take the regular overtime into consideration when looking at your, but you still make, and you are sure, but they won't look at it. So what we used to do there is to do self-certification. You will say, I make this money, and you commit yourself to it. So you won't have, because you will not have regular pay slip. You may have some pay slip, but you may not have, it may be irregular to the extent that the mortgage advisor will not, using prudential principle, they will not be able to say, this is predictable. Do they still do self-certification?
I can't say yes, I can't say no, but I think it may be possible. Okay. But I think things you can, like I said, things you cannot ordinarily get from the main lenders online. That's where brokers come in. The brokers, they have access to lenders who may be able to offer, to consider things that others might not be able to.
And one thing, don't run away from, if you know that going to mainstream lenders will be difficult. Don't shy away from going into all these people who can offer you readily. Because after 1 year, you can move to the high street. Because you are now in the property ladder. So your interest might be high to start with. But since once you are on the property ladder, you will be a toast to other lenders. But don't be like me. Once I start, I just forget about it and roll on.
Any other? Yes.
The question I have is about, some people will say, don't pay up your mortgage. So what is the advantage or disadvantage of that? They say, don't pay up your mortgage quickly.
I think those who say don't pay your mortgage is from the view of what I just told you. That is yeah. There's no. As I said, some of the things I knew, if I knew many years ago, I'll be much more better off. Rather than paying off, think about this way. When you pay off your mortgage, so you have a property, you pay it. So what next? So you have a house that's 100%, and value is just locked down. It's a 1 million whatever, but yeah, you are living in a house 1 million, but that's it. But value is just locked down. Cash is locked down. You can't do anything with it. Am I making any sense? Okay. Now, two people, they have two properties. Okay? Let's say this amount, 500 to 500,000. So one has fully paid his own. 500,000. So he's living in his house, comfort, He gets emotional satisfaction of living. I'm mortgage free. Yeah, it's good. You understand? Okay. But another person close to being maybe a few years before, like I used the example, took money out of it and used it to invest. And used to sit on another property. So he's still paying mortgage. So it's not mortgage free. Do you understand? But he has another property. When it's closed, whatever, he takes money out of it again. So he's building. So it's from the premise that you can take money from this to build
Establish something else.
property portfolios. That, again, by posting, like I said, you can go and check it. Properties double in value almost every 10 years. So yes, your property that's good. The advantage is that, okay, when we die, we pass on it as a inheritance to our children. So they benefit from it. Yeah, which is good. But again, for people who have advantage, many people are still, if you have an advantage of many years ahead of you, where you can still have access to whatever. So you will eventually pay off, but you will have actually been able to build up a good property portfolio from that, really, rather than just paying down and sit on it and say I'm living in my own house. So particularly if you are still economically active. You understand? If you are still economically active, you are working, so you can help. If someone is close to retirement and whatever, might not be whatever, okay, there might be less value in that. But if you're still economically active, you are working and you can continue to afford, so you could actually take advantage of that. So that's the premise of say, okay, what's the value in paying it off? If you can use money that's the value in that property to build up something. It's not about you want to go and not many people are good at doing business, but at least you can build up a property portfolio where you're getting rent. Of course, value is also increasing. In fact, many people, what they also do, you understand, which is it's like the property they buy as well. In 5 years, they can take money out of this as well. It's like a cycle. From property 1, you buy property 2. Property 2, you can take money out of property 2. In 5 years after. Yeah, many people are smart in the society. That's actually how many people.
Another disadvantage of not having mortgage, in addition to what Pastor Bilingue said, is that your credit nosedives.
Going down.
The day I paid off my mortgage, my credit rating. So you are not now classed as a homeowner. You have to prove it.
Are you a homeowner? When your application, are you a homeowner? Yeah.
Are you a homeowner? If you say yes, once your mortgage 0, it will knock you off. but I was ready for that status. I was ready for it. But if you are not ready for it, even if I used to advise people, because you cannot take a mortgage for small amount of money. So if you have a mortgage and you have money to pay it off, leave some remnants.
Yeah.
So you will still,
or maybe change it to interest only.
Or you change it to interest only. So that you will still see that you are owing. And the money you would have used, for instance, if you pay down, and you are now, the amount outstanding is about 10 or 15,000. That's nothing to the number of years. You will not be paying so much interest. So what you can do is either you change it to interest only, because if you don't change it to interest only, if you are paying the amount you were paying before, you will pay it off quickly. And the moment you pay, they will tell you your deed of conveyance is returned to you. In your credit, you are no longer having mortgage. So if you change it to interest only, the money you would have used, you can put it in a savings account. Barclays used to have a product whereby if you have interest bearing account with them and you have mortgage, they will net off. They won't take the money off you.
That's what I did in the first 5 years. I did because I had some savings. They call it offset.
Yes.
Offset, whatever. If you have cash,
Product.
you understand. If you have some money, it mimics overpayments. That's
Yes.
what it mimics. So I have some cash in a deposit in their. It should have been in their savings, but it's a special savings account. It doesn't earn interest. Okay, but they use that. They factor that in my interest. So if for example, my mortgage was 80,000 pounds. So they would have calculated interest between 180,000. But because if I have 10,000, so they are calculating interest based on 170,000.
Yeah.
Saving me significant interest higher than I would have earned in interest on this 10,000.
Yeah.
And also saving value. So they call it mortgage offset. You use so it mimics overpayment. You use your savings in that to it significantly reduces how much you will pay. But talking to about one person said, actually, if you are finished paying, if person you can actually still borrow money against property.
You can borrow money against property. There's some of us
So
that
it's
are
like
thinking
it's you can still borrow out of money if you are still interested in, but I'm not sure he's interested in that.
Any disadvantage in interest only, even the mortgage original.
Oh, there is disadvantage in interest only. Yeah, someone
especially long term.
Long term. I've used someone I know. You understand? Now, they are in fact in 2 years' time, their mortgage will end. But due to some financial circumstances, a few years ago they were doing interest only. Now, there's a gap now. So because in 2 years' time their mortgage will run out, because they do interest only, so they will be the bank expects them to pay off everything.
Yeah, at that time.
At that time. That's the disadvantage of interest only. Interest only fits only buy to let. And what's the reason? Because buy to let is an investment property. You are only banking on property appreciating the value. So you can sell it at any time, knowing that you will sell it for more than you have left to pay. So whatever is your profit. So that is when interest only.
And it depends on how the market moves. Because at that time they will be desperate to sell.
Yeah, that's on that.
Yes.
Okay, I just want to talk about, like, I want to ask a question based on the mortgage thing. So, some people do say 5% or 10%. I don't know if anyone has asked the question. So, I wanted to know, what is the benefit of someone buying on 5% or on 10%?
Okay, that's deposit.
Yeah, deposit.
Okay, like I said, okay, yeah, now, okay, even on the face value, when you have lower deposits, it means you are borrowing more. So that means really on the face of it, your interest is more. How much you're borrowing is more. So your monthly mortgage you're paying is more. So certainly that one is what you are paying. So maybe the person, if it's the same property, same property of same value, two people, 1 5%, 1 10%, because the one of 5% is borrowing more, what you'll be paying monthly will be more. But the second one is that, like I said, the higher your deposit, then the higher the chance of getting a reduced interest. A reduced interest. Because to them it's a risk when they are lending you money. So the interest is a return to them. And the principle of finance, the higher the risk, the higher the return. So because they are borrowing you more, it's intending for them to charge you more in interest. For example, if someone has if I have 90% cash deposit, I borrow 10%, very likely the interest I will get will be much more lower than you. So that answers that. So if you have more deposit, then you stand a chance of getting a reduced.
And now about the fixed rate interest are variable.
Okay, when fixed interest rate is based on fixed interest rates could be for 2 years, usually minimum 2 years, then 5 years, then 10 years, okay, can be 3 years. It means for that period, the interest rate is fixed. There's nothing, okay. You know what affects interest rate? Maybe then we'll look at it from there. What affects interest rate? Factors in the economy. Interest rates are set by Bank of England, or what they also call money market rates. All these things, they affect the economy. They affect interest rates. If inflation goes up, Bank of England will be forced to increase interest rate. Like it was, I think, like about in the last 7 months, there was a time interest rate was very, very high when inflation was like about 10-11%. So interest rate was increasing. So like I was saying, so that affects interest rate. So if you're on fixed interest rate, if you're on fixed rate for 5%, it means no matter what happens, nothing will affect your interest rate for that period of time. It doesn't matter if what happens, nothing is going to change it. Now, from variable rates, all you are saying, make my interest to be subject to how things are changing. So if you have two people, one person takes a particular interest rate for 5%, for 5 years fixed, I don't want to say variable. Even if the person gets variable, usually variable rate might even be lower. If it's 30%, it is possible that in 5 years' time, that could be up to 10%. So, but like I said, it's always which one to choose. It's always up to each individual. You analyze your circumstances. You analyze your what you can afford. I use my own as an example. I say in my case, I wanted predictability. You understand? Because so I took 5 presumably within a reasonably long period, because it was a first thing for me. So I wanted 5 years. I won't need to bother myself about if interest rate increases or not. So I took 5 years. So that fixed, but that might not apply to that. You might arrive at a different decision at that time than I arrived at. You might say, oh, no problem, I can. Yeah. So it's no one can tell you do fix 2 years, whatever. You have to analyze it, based on your situation, and make your decision. Because each one has risk. If you take variable, there's a chance that it can increase. If you take fixed, there's a chance that interest rate can go down and you have to be paid more. Yeah. So
just like gambling.
It's more or less now.
If you are taking very because they just try to think otherwise. Probably is a positive or negative.
So you analyze it and say, okay, which one am I comfortable with? Like I said, there was a period I actually went for fixed but for 2 years, not longer, because I thought, what if I said things might change the economy that I think will actually move interest rates up? But I said, okay, but even if it moves up whatever is left, I was comfortable that I could afford it, so I just took it.
So, but is it possible if you've done your 5 years fixed and after the 5 years,
after it's for a period. So after the end of the, usually like about in the last year, like about 6 months.
Gentlemen,
like about 6 months to the end of that term, you will be open to discuss new term with your bank. But let me also say, it doesn't have to be your own bank. You can actually, yes, you can actually, if you get a better option from another bank, you can actually transfer your mortgage to another lender.
Oh, you can.
Oh yes, you can. Oh yes.
Thank you.
You can transfer your. You don't have to stay with your lender. If you find another lender, the only challenge you will have is that where you are transferring to, they have to assess you again. Afresh, because it's a mortgage you are taking. So the advantage of staying where you are is that you will not be subject to all the assessments again. Does that make sense? You won't be subject to that. So typically people stay, but really you are not obliged to stay. If you have a better offer somewhere, you can transfer your baggage as well. So usually like about 6 months to the end of that, you'll be open to new offers. So you can say, okay, after this ends, I want to do 2 years fixed. I want to go to variable. I want to do that.
Thank you, sir. Any other question? Or all right, so maybe we need to be fast with it now.
From talk about trying to pay more, that's paying more on the mortgage, and then coming to when you are done with the first fix. Is it possible that when you're done with the first fix and then you want to,
you mean the term?
Maybe 5 years, maybe 5 years or 3 years, when you are done with that, and you want to move on to another person. Is it possible to another lender rather? Is it possible that you put a certain amount of money to cushion what you're going to be borrowing this time? As in, if you have more money now to quickly put into it, is it possible that or you are subject to?
No, the first issue is that, let's say you start after 5 years, your property has increased in value, something that you have. How much you have to pay has reduced because you pay 5 years. So you actually have equity. What they call equity is how much you have in that property. You have equity on that property now that was more than you had when you bought it. So which means, if for example you are considering transferring to another lender, potentially you have a higher deposit on this property, isn't it? Because your equity is like a deposit now. Potentially you have a higher deposit on this. So which means, like I said, the higher the deposit, the better the chance of getting a reducing interest rate.
Thank you.
So you understand. So, and it is whatever is left. If you have been overpaying, it is whatever is left is that you are owing, that you are now transferring, that you are borrowing from another company. So the fact that your equity is more now than it was, which means your deposit is more. Your LTV is lower now. That means you have a chance of getting a reduced rate. But really, to where you are, because they are also in the market, they will not want to lose you. So they know they are competing with others. So this is how you have to factor. The fact that if you are moving, they will do all your assessment again, they will do income assessment, they will do affordability check, whatever. Whereas where you are, they will not do all those things. They will just, because you're already with them. So that is your deal.
Yeah, what I'm actually asking is apart from the trend of borrow, you are in it borrowing. So when you want to move to borrow from the next person, because you are transferring to them, for example, what you have left as the amount to pay up is what you are borrowing.
Yeah.
Say you have
even though you can borrow more,
50,000 to borrow. Say you have 150,000 to borrow. Is it possible that if you have 50,000, you put your 50,000 and say, I'm paying this.
Oh yes,
I have only 100,000.
That deposit.
It's not. You see, when you go to another, what you do now is you call remortgage. What are you doing to remortgage? So it is not automatic that it is 150 you transfer. You understand? It's not automatic. You can say no, because you can say I'm increasing my deposit. That's what you are doing. You understand? Or yeah, I'm increasing my deposit. That means I'm borrowing less. Yeah, you can borrow less, but you can borrow more as well. You can borrow more than the 150. Someone can say, I'm charging 150, but please can you borrow me again? And another 10,000. I want to extend the property. Yeah, they will consider that as well. So you can do that with your lender or with a new lender. So it doesn't matter. It's an open market.
Thank you, sir. Okay, but I think there's a percentage, there's a maximum that you can pay if you want to pay in bulk or something like that. So we still
when you are moving to a new lender, you can actually pay more.
Okay, sir. All right. So thank you. Get property. They look at the deposit source. Some people do contribution and all of that. But there are a lot of people out there that tell them that okay, really. that's the word. Well, some people say it's not allowed. Some people say it's allowed as well. So
once you can prove, I think it can be allowed.
Actually, when I did it, but nobody, I think we just asked questions from. They didn't query.
They do it
in my case. They do
it now. Even there was a time one of my children, they were buying a house, and they said I should bring a letter, and I should
certify that deposit.
That I should certify that I do not have interest in the property. So when I wrote that, they now say I should prove where that money is coming from. So I had to send my savings account and to see that the money had been there for long. That was when they now accepted it. Otherwise, they were not going to accept it. So now you have to prove.